Did you know that over 90% of the variability in investment returns can be attributed to asset allocation decisions? It's not just about picking the right stocks or funds. How you allocate your assets can make or break your portfolio's performance. So, are you sure your asset allocation is optimized for your financial goals? Welcome to this deep dive into mastering asset allocation, the foundation of any successful investment strategy. Whether you're a conservative investor seeking stability, a moderate investor balancing growth with safety, or an aggressive investor chasing high returns, how you allocate your assets plays a crucial role in your financial success. In this comprehensive guide, we'll explore the importance of asset allocation, why it matters for every investor type, and how to tailor your strategy to fit your unique financial goals and risk tolerance. One of the biggest challenges investors face is determining how to allocate their assets effectively. With market volatility, economic uncertainty, and an overwhelming amount of investment options, it's no wonder many people struggle with this crucial aspect of investing. Often, investors either take on too much risk or play it too safe, missing out on potential returns. Additionally, a lack of knowledge about how to diversify effectively can lead to portfolios that are overly concentrated in certain asset classes, increasing vulnerability to market downturns. Without a well-thought-out asset allocation strategy, investors may find themselves with portfolios that don't align with their financial goals or risk tolerance, ultimately impacting their ability to achieve long-term success. To build a strong asset allocation strategy, it's essential to first understand the different asset classes and how they behave. The primary asset classes include equities, stocks, fixed income, bonds, cash and cash equivalents, and alternative investments such as real estate, commodities, and private equity. Each asset class has its own risk and return characteristics, making them suitable for different types of investors. Equities represent ownership in a company and offer the potential for high returns, but they also come with higher risk. Stocks can be volatile, especially in the short term, but they have historically provided strong long-term growth. Equities are well suited for investors with a higher risk tolerance who are looking for growth and are willing to ride out market fluctuations. Bonds are loans made by investors to corporations or governments, providing regular interest payments and the return of principal at maturity. Bonds are generally less volatile than stocks and are considered safer investments, making them ideal for conservative investors seeking steady income and capital preservation. However, bonds typically offer lower returns than equities, particularly in a low interest rate environment. Cash equivalents include money market funds, certificates of deposit, CDs, and treasury bills. These are the safest investments, offering liquidity and capital preservation, but they also provide the lowest returns. Cash is crucial for meeting short-term needs and serves as a buffer against market volatility, but holding too much cash can erode purchasing power over time due to inflation. Alternative investments encompass a broad range of assets, including real estate, commodities like gold and oil, private equity, and hedge funds. These investments often have low correlation with traditional asset classes, providing diversification benefits. However, they can also be illiquid and complex, making them more suitable for sophisticated investors with longer time horizons and higher risk tolerance. Risk tolerance refers to an investor's ability and willingness to endure market volatility and potential losses in pursuit of higher returns. It's a key factor in determining the appropriate asset allocation. Investors can generally be categorized into three main types based on their risk tolerance and investment goals: conservative, moderate, and aggressive. Conservative investors prioritize capital preservation and steady income over growth. They tend to have a lower risk tolerance and prefer investments that offer stability and protection against losses. For conservative investors, a portfolio might be allocated primarily to bonds and cash, with a smaller portion in equities or alternative investments to provide some growth potential. Moderate investors seek a balance between growth and income with a willingness to take on some risk in exchange for higher returns. They typically have a medium risk tolerance and a longer investment horizon. A moderate investor's portfolio might include a mix of equities, bonds, and some alternative investments, offering both growth potential and stability. Aggressive investors are focused on maximizing growth and are willing to accept significant risk to achieve their goals. They have a high risk tolerance and a long time horizon, which allows them to ride out market volatility. An aggressive investor's portfolio might be heavily weighted toward equities with smaller allocations to bonds and alternative investments. Now that we've covered the basics, let's explore specific asset allocation strategies tailored to each investor type. A common asset allocation for conservative investors might be 70% bonds, 20% equities, and 10% cash. This allocation prioritizes stability and income, with bonds providing steady interest payments and capital preservation. The small equity allocation offers some growth potential, while the cash component ensures liquidity and protection against market downturns. Moderate investors might consider an allocation of 60% equities, 30% bonds, and 10% alternative investments. This balanced approach provides a mix of growth and income, with equities driving capital appreciation and bonds providing stability. The inclusion of alternative investments like real estate or commodities adds diversification and the potential for uncorrelated returns. Aggressive investors might allocate 80% of their portfolio to equities, 15% to alternative investments, and 5% to bonds. This strategy maximizes growth potential by heavily weighting equities, while alternative investments offer diversification. The small bond allocation provides some income and stability, but is kept low to maintain a focus on growth. No matter what your asset allocation looks like, it's crucial to regularly review and rebalance your portfolio. Rebalancing involves adjusting your asset allocation back to its target percentages after market movements cause them to drift. For example, if a strong stock market rally causes the equity portion of your portfolio to exceed your target allocation, rebalancing would involve selling some equities and buying bonds or cash equivalents to restore the original balance. Rebalancing helps maintain your desired risk level and ensures that your portfolio remains aligned with your financial goals. To illustrate the power of effective asset allocation, consider the story of Jane, a moderate investor who successfully navigated the 2008 financial crisis. Before the crisis, Jane had a balanced portfolio with 60% equities, 30% bonds, and 10% real estate. When the stock market plummeted, many investors panicked and sold their assets, but Jane stuck to her asset allocation strategy. Her bonds and real estate holdings provided stability, cushioning the impact of the equity market crash. As the market recovered, her equities rebounded and her portfolio regained its value. Jane's disciplined approach to asset allocation not only protected her during the downturn, but also positioned her for strong returns as the market recovered. In conclusion, mastering asset allocation is essential for every investor type, whether you're conservative, moderate, or aggressive. By understanding the characteristics of different asset classes and aligning your allocation with your risk tolerance and investment goals, you can create a portfolio that balances risk and return. Regularly rebalancing your portfolio ensures that you stay on track and maintain the desired risk level. As we've seen through Jane's story, a well-thought-out asset allocation strategy can help you weather market volatility and achieve long-term financial success. Now that you've learned about the importance of asset allocation, I'd love to hear your thoughts. How do you allocate your assets? Have you had any experiences with rebalancing during volatile markets? Share your stories in the comments below. And don't forget to check out our next video, where we dive into advanced investment strategies that can help you take your portfolio to the next level.